Good afternoon, boys and girls. Welcome to the weekly economic update for Monday, April 4th, 2022. I hope everybody had a fantastic weekend out there in the interwebs. It was pretty nice here. We had fairly warm weather, got to go outside, got to do some chores outside, which for anyone who's lived where it snows and has dogs is aware that once the snow recedes, you get a present that is quite unenjoyable. You get petrified dog poop that's been under the glacier in your backyard. So I filled up two kitchen size trash bags on, I think, Saturday. So after I'm done with this, I'm going back out to go and finish cleaning up the rest of it. So anyways, hope everyone, like I said, hope everybody had a great weekend. The Final Four was on, or the semifinals was on Saturday, both really good games. Here's my prediction for tonight. I think Kansas will win. Reason being, Duke and North Carolina were beating the crap out of each other. And it's, I mean, such an intense rivalry already. You know, North Carolina, beat Duke at Coach K's last game. And then, then they wind up playing each other in the Final Four. So I think, North Carolina, even though they won the game against Duke, I don't think they're going to have much steam left. Now, again, I could be completely wrong. Hubert Davis could have them all recharged and ready to go. But I think it's probably going to be a letdown. It, kind of reminds me of the 83 Final Four where the Cougars and they played Louisville, and it was just a back and forth game, back and forth. And then Monday night came around and U of H threw up a stinker versus NC State. So anyways, you didn't come here to hear about college basketball, did you? No, you came here to hear about what's going on in the markets. So let's go ahead and jump into that. All righty. Dow Jones was up today, 0.30%, closing at 34,921. S&P 500 was up 0.81%, closing at 4582. NASDAQ up 1.9%. Wow, 2%, nearly 2% today, closing at 14,532. Small caps are up a little over 0.5%. The VIX receded 5.4% today, closing at 18.57. Yeah, over the overnights on the VIX, they were in the green. So I think it was up at around 22. Last time I looked at it, probably about midnight, 12:30. Again, I'm weird. I check the futures all evening and until I fall asleep. So always trying to stay on top of what's going on. All right. The other exchanges here in the Americas, Canada was up 0.6, Brazil down 0.23, Mexico down 0.49. Let's move over to Western Europe. Germany up 0.5%. UK up 0.25%. France up 0.7. The Euro stock's up 0.83. Is that the Netherlands? Yeah, the Netherlands up 1.35. And just green. Let's see. The first red I see is Austria. And the next one is Denmark. Both of the Russian exchanges are still back open, up 1.02 for the MOEX, and the RTSI was up 1.75. Let's see here. Poland was in the red by 0.32, and everything else green all the way from Hungary to Asia. Everything was up. Let's see what the best one was. Looks like the China A50 was up 1.88, and the Hang Seng was up 2.1%. Taiwan weighted was down 0.38, and then looks like the rest of these mostly up, except for Pakistan and Sri Lanka, and those are, I imagine, fairly small markets there. So all in all, for April 4th, it looks like a pretty good day across the globe. So again, don't think that we're out of the woods yet. We certainly have a lot of got a steep climb ahead of us. Unfortunately, with trying to dig ourselves out of this inflation and everything else that's going on in the world. So let's all right. So let's jump into the weekly economic update. Week on Wall Street, stocks spent last week digesting the sharp gains of previous weeks as investors assessed a tightening yield curve, the war in Ukraine, and an uncertain outlook for economic growth and inflation. The Dow Jones Industrial Average slipped 0.12%, while the S&P 500 was flat at up 0.06. NASDAQ index led by picking up 0.65 last week, and internationals rose 1.02%. Stocks pause. Stocks prices rebounded or bounded. Start over. Stock prices bounced around following strong gains in two previous weeks as money managers appeared to reposition their portfolios ahead of the first quarter close. Oil was under pressure all week as prices fell on news that Shanghai imposed a strict lockdown due to COVID infections. Ooh, I bet they're all getting the sniffles over there. President Brandon announced a sustained release of oil from the country's strategic petroleum reserve. Bond yields reversed their recent climb. The flattening in the yield curve triggered some concerns about economic growth and the possibility of a recession. The labor market. With economic growth worries overhanging the market, last week's employment report showed continued strong demand for workers. The job openings and labor turnover survey reported the number of open positions remain near record highs, with job openings exceeding the number of available workers by a record 5 million. Afterward, the automated data processing employment report saw private payrolls grow by 455,000 in March, slightly above consensus expectations. Finally, the government's monthly jobs report showed that employers added 431 jobs in March, lowering the unemployment rate to 3.6%. That's approaching the 50-year low of 3.5% reached in February of 2020. All right, so we got some economic data coming out this week. Monday, we have factory orders. Tuesday is the ISM Services Index. Wednesday, the FOMC committee meeting minutes. And Thursday, we got jobless claims. Just two companies reporting earnings this week, Levi Strauss & Co. on Wednesday, and on Thursday, we have Conagra Brands. All right, so that's everything there as far as the weekly update. Let's take a look at the market recap here from investing. The S&P 500 advances as Twitter leads tech higher. It's written by Yassine Ibrahim. The S&P 500 Monday. Fix this. The S&P 500 rose Monday as a Twitter-fueled jump in tech helped the broader market start the week on the front foot. Twitter jumped 27% after the Tesla CEO Elon Musk became the social media's giant's largest shareholder, taking a 9.2% stake in the company. So that should be interesting to see because I know he's very much a free speech person, and it'll be interesting to see if he comes in there and cleans house with all the cancel happy retards that are there. Musk, a vocal critic of Twitter, isn't expected to be a passive shareholder and will likely look to build on his stake to influence change at the social media giant. Quote, "We would expect this massive stake as just the start of broader conversations with Twitter board and management that could ultimately lead to an active stake and a potential more aggressive ownership role of Twitter," end quote, Bush said in a note. Other social media stocks, including Snap, Meta, and Pinterest, were up sharply. Tesla, meanwhile, gained 5% as the electric car maker delivered a record 310,000 vehicles during the first quarter, just shy of Wall Street's estimate of 312,000. Big tech, meanwhile, started the week on the front foot. Apple was up more than 1% despite negative commentary from Loop Capital forecasting the tech giant to slash iPhone production for 2022 to a range of 245 million and 250 million. Microsoft Corporation, Alphabet, and Amazon were up more than 1%. A key part of the yield curve, the 10-year Treasury yield over 2-year Treasury yield remained inverted on Monday, keeping fears that a recession may be brewing front and center. Folks, it's been brewing for 2 years. If you think all this is just happening all of a sudden, with Russia and gas prices going up, this has been in the works for several years now. So don't be surprised. Remember, you voted for the people who implemented this stuff. So enjoy your high prices. Financials were dragged lower by falling bank stocks as a flattening yield curve limits their margins of lending. JPMorgan Bank was less than 1% higher after Chief Executive Jamie Dimon said the bank could face a potential $1 billion write-down from its assets in Russia. On the Ukraine-Russia war front, peace talks between the two nations resumed Monday, despite the U.S. and its allies eyeing fresh sanctions on Russia after reports of mass civilian deaths in Bucha, Ukraine. Energy stocks struggled to turn positive despite rising oil prices, rallied as expectations of fresh sanctions against Russia stoked fears of tighter supplies. ExxonMobil was flat after forecasting a rise in quarterly operating profit in the first quarter, underpinned by rising oil and gas prices. In other news, Starbucks fell more than 4% after the coffee chain suspended its share repurchase program. All right. So excellent news there, guys. Market looks better on paper today, but I wouldn't get your hopes up because, again, I think we're heading towards, remember Thelma and Louise, how they drove off that cliff and yeah, that's unfortunately where we're headed. All right. Next article comes from Brian Westbury at First Trust Financial. We are all Keynesians now. The intellectuals and politicians often try to verbally summarize or justify conventional thinking in pithy ways. Milton Friedman in 1965 and Richard Nixon in 1971 both said different versions of the phrase, "We are all Keynesians now." John Maynard Keynes, one of the most famous economists of all time, supported deficit spending and government manipulation of economic activity. That's why I think John Maynard Keynes was a retard. Ludwig von Mises is a far better economist. Friedman and Nixon were describing the thoughts behind the implementation of the Great Society redistribution programs and an inflationary monetary policy designed to offset costs of those programs. If economic policy was Keynesian in the 1960s and 70s, as policymakers stopped believing in free markets, we are completely all Keynesian now. COVID spending and monetary policy are a clear continuation of this economic thinking. It all began in 2008 when the Bush and Obama administration combined to spend $1.5 trillion of taxpayer money to rescue the economy, and the Federal Reserve started quantitative easing. That blueprint of policy response to the panic of 2008 was used to respond to COVID shutdowns. This time, the federal government borrowed at least $5 trillion to spend, and the Fed increased its balance sheet by over $4.5 trillion. As a result, the Keynesian policies of the 1970s, the U.S. experienced stagflation, slow growth, and high inflation, with both unemployment and inflation peaking in the double digits. Right now, inflation is 7.9%, and the unemployment rate is 3.6%. So while inflation is clearly here, signs of stagflation are harder to find. That doesn't mean economic growth isn't being impacted. There are multiple forces to analyze and untangle to understand everything that first lockdowns and government largesse have done. First, the U.S. economy was artificially boosted by borrowing money and distributing it through PPP loans and pandemic benefits. Case in point, retail sales are up 25.2% between February of 2020 and February of 2022, while industrial production is up just 2.3%. And the U.S. has 1.6 million fewer jobs than it did pre-lockdown. The good news is that unlike the Great Society programs, the spending done in response to the financial crisis and COVID-19 are not all permanent increases in entitlements. Some of our COVID response spending is likely to be permanent, but not all of it. Second, the M2 money supply has increased more than 40% since February of 2020, as the Fed renewed QE and monetized deficit spending. In other words, a great deal of that spending was paid for out of thin air. The impact of these policies was like giving morphine to an accident victim. The economy was dramatically damaged by the lockdowns, but the morphine masked the pain. All that painkiller stimulus boosted sales and profits. This year, without new spending legislation, and as the Fed starts to reverse course, the economy will lose its morphine drip. On the surface, this suggests that the economy could be in trouble, and with the 2-year Treasury yield now above the 10-year Treasury yield, and in what we call an inverted yield curve, many think the U.S. faces a recession this year. But this ignores the impact of the third factor in play, the reopening of the economy. It is clear, at least to us, the very generous pandemic unemployment benefits had a massive impact on employment. In fact, the Great Resignation, people just dropping out of the workforce, had a lot to do with these benefits. While it was never the case, many thought that Build Back Better spending bill would keep these checks coming. Now the BBB appears dead, thank goodness. These people are headed back to work in the first 3 months of 2022. 1.69 million jobs have been filled. This year will likely total 4 million jobs or more. So even though the Fed will be lifting rates and Keynesian deficits will be smaller, the economy will expand in 2022 and the profits should continue to rise. Unfortunately, our forecast is that real GDP will remain under 3%, while inflation remains over 5%. This is reminiscent of the 1970s, and once the reopening from lockdowns is over, the full impact of these policies will be felt. The inversion in the yield curve suggests the bond market thinks that if the Fed lifts short-term rates to 3% or so, it will be forced to cut rates again. This may be true, but we think inflation will prove more persistent problem than the Fed or the bond markets have priced in. The U.S. is now stuck in the Keynesian dilemma of its own making. The way out is to cut spending, cut tax rates, cut regulation, tighten money money enough to stop inflation. Because in the end, Keynesian policies don't create wealth, free and open markets do. Thank you, Brian. I couldn't agree more with that. Again, we could have, it was very clear 2 years ago that this was going to lead to bad problems, but hey, give free money to, it was an election year. You couldn't let people, have to actually work for their money. I mean, come on. All right. Next article, Ray Dalio. Some of y'all might know him. Quote, "We are approaching a challenging of the world order." All right. Billionaire investor and financial historian Ray Dalio is growing very concerned about a new world order as economies battle through high levels of inflation, bloated debt positions, and various geopolitical tensions. Quote, "We are approaching a challenging of the world order," end quote, the Bridgewater Associates founder and chief investment officer said in a new episode of Yahoo Finance Presents. Dalio added, "There's an increased likelihood of some kind of war." Really? Quote, "There are 5 kinds of war. There's a trade war, technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. Those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases," Dalio explained. Pick your poison as to the potential drivers of Dalio's New World Order. Inflation in advanced economies such as the United States continues to run red hot. Ditto for emerging markets. The Federal Reserve is lifting interest rates, driving up costs of business capital on businesses, and the Russia-Ukraine crisis has caused increased tensions between the West and superpowers Russia and China. Dalio is concerned on the impact of these variables have on the value of money. Quote, "When you run very large deficits, you have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs, and so on. And so when you spend a lot of money, a lot more money than you earn, then you have to print money to make up that difference, to make purchases, and then then that devalues money," Dalio added. "So as money goes into other assets, it produces more inflation, and you start to enter a certain type of environment, and that environment is what we're beginning to be very much like that of the 1970s. So again, another big brain kind of guy in this line of work is really worried about where things are going. So again, these are the tea leaves. I mean, seriously, if you haven't started building your bunker, you might want to do it. All right. Last article I got here, Jamie Dimon, or JPMorgan's Jamie Dimon, Fed to hike rates higher than the markets expect. Head of the largest U.S. bank said markets are underestimating the speed by which he expects the Federal Reserve to raise interest rates. In a letter to shareholders released Monday, JPMorgan Chase CEO Jamie Dimon added that short-term borrowing costs need to be substantially higher to address the rapid pace of price increases. Quote, "The stronger the recovery, the higher the rates that follow. I believe that this could be significantly higher than markets expect," end quote, Dimon penned in the annual letter. Dimon's remarks suggest that the Fed could lift interest rates more than 2.5% this year, as some betting markets are pricing in. High inflation and a strong labor market recovery pushed Fed Chair Jerome Powell and his colleagues to pull back on the central bank's extraordinary pandemic-era monetary stimulus. Beginning with the first post-COVID interest rate hike last month, the Fed is now in the early innings of an interest rate hike cycle that will likely include further interest rate hikes through the rest of 2020 and likely beyond. But it remains an open question as to how high the Fed needs to raise short-term interest rates, now in a target range between 0.25% and 0.5%. There's also the question of how fast the Fed needs to implement those rate hikes. Several Fed officials are hinting that a double bump in interest rates rate hikes could be coming in the future meeting. San Francisco Fed President Mary Daly, for example, told Financial Times on Friday that she sees the case growing for a 0.5% rate increase in May. The Fed has not raised interest rates in increments larger than 0.25% since 2000. Dimon said the Fed should be open to more aggressive moves if the data continues to show unparalleled inflation. One thing the Fed should do, and seems to have done, is to exempt themselves, giving themselves ultimate flexibility from the pattern of raising rates by only 25 basis points and doing on a regular schedule, Dimon said. The Fed itself is projecting 7 total rate hikes through the end of the year to target range between 1.75 and 2%. Fed fund futures markets are pricing in odds of a more aggressive Fed to a target range rate between 2.5 to 2.75. The nation's top banks stand to benefit from higher interest rates, although JPMorgan Chase and other large banks have managed strong profits despite rock bottom interest rates. Higher rates would allow banks to expand margins on their lending products, i.e. business loans, mortgages, and credit cards. In January, when the Fed was telegraphing fewer rate hikes than they are now, Dimon was similarly telegraphing that he could see the central bank moving faster than expected. So again, the news is out there. They've been telegraphing this since probably November, October last year. The rates are going up. If you're going to buy a house or refinance, do it today. Because the price of money is going to get much, much more expensive over the next couple of years. So probably back to what it normally should have been. But hey, we're going to have to, it's kind of like when you stretch a rubber band out, and when you let go of one side, it snaps back really, really fast. So we've had, next to zero interest rates, really since the financial crash back in 2008 and 9. So for the better part of more than a decade, there's a lot of pent up malinvestment in the system. So I'm completely, I'm curious to see what's going to happen. So it'll be interesting to see. It's going to be a fun ride. For those who aren't prepared, you might want to go buy a cup at the sporting goods store, because we're going to get kicked in the nuts pretty hard. So anyways, all right. Well, that's everything I had for today. Hope everyone got some value out of this, and I try to keep this entertaining. I'll be back tomorrow with the Liberty Call, and if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there, so you can, if you want to book an appointment or send me a note, feel free to do so. All right, well, I'll be back tomorrow, and I'll see you then. Bye.